Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Is the movement in VOLQ relative to VIX an indication that the Nasdaq-100 is falling out of favor? Joining us to answer is Dr. Russell Rhoads, Associate Clinical Professor of Finance at Indiana University. Russell, it's great to see you as always. Welcome back to Trade Talks. And what are you noticing in some of the movement with VOLQ?
Well, what's kind of interesting with respect to VOLQ and VIX, the relative relationship sees VOLQ at a discount relative to VIX, maybe 20-25% of trading days. We have not seen VOLQ at a discount to VIX until past couple of weeks for well over a year. So we'd had higher volatility expectations in the Nasdaq-100, and typically you think of higher volatility or higher relative volatility expectations as being somewhat bearish. But Kevin David over at Nasdaq pointed out a while back, and it continues to hold up, that some of the VOLQ elevated levels now, where we flip back to where VOLQ is at a premium, that's actually a function of call buying more than anything else. And typically we don't see volatility indexes being driven by call buying. So the FOMO trade to the upside with the NASDAQ up, or Nasdaq-100 up like 25% this year. That's one of the things that's pushing VOLQ back to relatively high levels relative to VIX. Typically, you think higher volatility expectations, maybe a more bearish outlook, but I don't think it equates to that in this situation.
And the Nasdaq-100 one day at the money straddle pricing is much lower than where it has been over the past few months. What's the significance of that?
Well, I've been tracking. I got to get a lot of numbers here, so I got to get my paper out. So the Nasdaq, we've been tracking the one day at the money straddles the day before, and then at settlement, and we price them out as a percentage of the index. And going back to the beginning of 2022. Every time that we had a one-day PM settled NDX straddle, we recorded what it was pricing in and what the result was. On average, the at-the-money straddle has been pricing in a one-day move of up or down 1.4%. However, starting with December of last year, that number has just trended lower from month to month to month. And in fact, it was well below, it was around 0.7% or so in May. And even when we had the employment number last Friday, again, the average at the money straddle prices in about 1.4%, and it was pricing in a 0.99% move or a 1% move in the Nasdaq-100 and the employment day. And it was pretty accurate, as the reaction on Friday was a gain of 0.73%. So cheaper than normal relative to history, and definitely relative in front of a big event, but cheap for a reason, because the realized volatility came in below what the straddle was pricing in.
And that's really what we're seeing in the equity markets, with the exception of the move that we saw on Friday. It really has been some sort of range bound, not much fireworks. I mean, it hasn't been, that exciting of a market, if you will.
And typically I guess the headline grabbing moves, without having any numbers in front of me, but just memory serves right, they've been to the upside. They've been these melt ups, not these huge down moves. Or when we've been getting the down moves, they seem to catch a bid at the most within a day or two after we get these down moves.
All right, Russell, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.